Hey, hello everyone. Welcome back to this YouTube channel 30CAGR. In this video, I'm going to talk about a very important topic that might help hundreds and thousands of intraday traders who are trading in option short straddles and strangles. These traders, what they are doing is they are doing all their backtesting on platforms like StockMark, but most of them are failing to reproduce the results in their trading account. Some people say that the backtesting software is wrong, and some people say that the data is incorrect. But let me tell you, it is a trader who is doing the backtesting incorrectly. Since many people are approaching me with this problem, I thought I'll make a video and explain some key concepts. Today, I will explain six most important things users ignore while performing these backtests. And at the end, I will also tell you the realistic percentage one can expect from these intraday short straddles and strangles. And of course, I will also tell you two major hurdles one has to cross in order to earn decent returns. So stay tuned till the end. My name is Raj, and 30cagr.com is my blog. I started this blog a few years ago with a goal to make 30% returns year on year. Whatever is the market phase, markets can be bullish, bearish, or sideways. My goal is to make around 30% returns consistently year on year basis. So, with that goal, I have started this blog, and I have two strategies currently. One is called ISS strategy. This is for intraday option traders, but the key thing is we execute this strategy using a fully automated trading bot. And the second is called PDR strategy. This is another flagship strategy of my blog. PDR stands for portfolio diversification and rebalancing. This is mostly for working professionals who can't spend so much time in stock market, or this is also for people who want to diversify their investment. Instead of putting all the capital in one strategy, if someone wants to diversify and keep it in some other safe strategy, then this PDR strategy will help them. So these are the two flagship strategies that I have currently. And in case if you wish to know the details of these two strategies, feel free to visit my blog and get the details for free of cost. And finally, if you haven't subscribed to my YouTube channel, please subscribe and hit on bell icon. As I said, I have two strategies currently, and I am planning to add more strategies to my blog in the coming years. So, in case if you wish to know more strategies or if you want to avail our trading tools, make sure that you subscribe to my YouTube channel and hit on bell icon. All right. So even before talking about these factors, first let's visit the site StockMark and look at a few details there. So this is the website stockmark.in, and first I would like to talk a little bit about its founder. Person who founded this website is Nitish, and if I can say, he is the one who has changed the face of intraday option trading for retail traders. I've had a few interactions with him. He's a very humble and down to earth person, very key learner, and we have to give credits to Nitish for building a website like this. There are so many traders who have completely shifted their trading strategies because of this backtesting tool. So kudos to Nitish for building such a wonderful platform. If you are new and haven't tried this platform, I'll put the link in the description. You can open a free account, go through these educational videos. Nitish has explained all these concepts very clearly, how to do the backtesting and other things. You can go ahead and watch it. But if you are already an experienced trader and have tried this platform, you can continue watching this video. All right. Now we are looking at six important factors that are going to change the way that you look at these backtesting results, right? We will start with the easiest ones and then go towards a little advanced concepts, right? The first one is slippage. Let me go back to the tool and run a simple strategy. Bank Nifty, 30% stop loss, entry time is 10 o'clock, and then exit time is 3 p.m., right? And the time period that I'm selecting is from 2017, and let me hit on start backtest. All right. Now we have results with us. If you look at the results or this summary table, it shows that 6,41,000 is the profit for 4.5 years approximately. And users just come do the back test, think that this is the profit that they are going to get. And some people, of course, they look at maximum drawdown. And if users are a little more advanced, then they might also look at MDD and expectancy, return to MDD ratio and expectancy, right? But let us see why we cannot get these profits. First thing, as I explained, is slippage. What is a slippage? So slippage is like an expense that you have to bear while entering into a trade and exiting into a trade. Okay, simply put, it's like the difference between buyer and seller. If you want to know more about slippage, you can go to YouTube and then find more videos about that. But you need to understand that every trade that you take, you have to bear some kind of slippage. Now, $1 million question is how much should be the slippage? There has been a lot of debate around that. But what I suggest is generally slippage would be around 0.4 to 0.5%, right? You need to enter slippage here for both entry and exit. So if you give 0.5%, then it means that this tool is considering 0.5% slippage while entering and 0.5% slippage while exiting. But that's not it. Let me tell you, you have to enter 1% slippage. This is the most important thing that you have to understand when you are dealing with slippages. But why are we entering 1%? We are entering 1% because it is not just the slippage that you have to pay when you are entering and exiting a trade. There are also other costs that you have to bear, like brokerage or transaction charges, stamp duty, etc. So all these also might account to 0.5%, right? So 0.5% you will have slippage, and then 0.5% you will have all these other costs. Now some people ask me, why should we include those extra expenses like brokerage and other costs in this field? We can also take it outside stock mark and then consider, right? The reason why we have to include it here is for drawdowns. Okay, let me ask you a question. Is your broker charging the brokerage at the end of the year? Or is government charging the stamp duty at the end of the year? No, right? All these expenses we will pay every single day, which means if you are having continuous losses, all those costs and expenses will add up to your existing drawdown. So, to get a sense of realistic drawdown, you have to include those expenses also in the slippages field only, right? So 0.5% slippage, 0.5% expenses, both at the entry side and exit side. You have to enter here and then hit on this button. Now observe the number that you see here, 6,40,000 will be changed, and at the same time this drawdown also will get changed. Let me hit on refresh. All right, if you see here, 6,40,000 straight away came down to 3,88,000, and even the drawdown, it went up from 29,000 to 36,000. Truth is bitter, but let me tell you, you always have to know the exact amount that you are going to earn while you are trading practically. Let me also tell you, this is also not the amount that you are going to earn. We will look at other factors also, but for now, just remember 3 lakh 88 or 3 lakh 90,000 is the amount that you are getting for 4.5 years, right? And drawdown also increased to 36,000. And this is the actual and realistic drawdown that you might face in the real time, because this accounts slippage and other expenses as well, like brokerage and transaction costs. Now the second thing that you have to remember is subtract profits from COVID times. Many people, what they do not consider is the extraordinary profit that these backtesting tools show during the times of COVID. Look at this monthly breakup table. If you look at the monthly P&L, it's in the range of around 5,000, right? Or maybe some months even got 10, 15,000. On an average, looks like it has given around 7,000 to 10,000, right? But look at this. In March 2020, it has given 61,400. And in some backtest results, you also see that April month also has given a lot of profit. You have to subtract this because these profits cannot be reproduced unless there is a black swan event again. And black swan events happen once in 5 years or 10 years. And so it is extremely impossible for us to have these profits in our practical trading accounts. So maybe out of the 60,000, we can deduct 50,000, which makes the overall profit as 3 lakh 38,000, right? Or 3 lakh 40,000. So for 4.5 years, your actual profit is 3 lakh 40,000. This is the profit that you are going to get in your account. Be prepared for it. Have your expectations clear, and you will not be disappointed during the real time trading. And then the third one is spread of profits. Again, let me go to this monthly breakup. When I talk to traders, most of them, what they focus on is the number of months that a particular strategy has given profits, right? They always tell me that out of 50 months, 48 months a particular strategy has given profit, or 45 months it has given the profit, right? But what I suggest you is, in addition to this monthly breakup, pay attention to your yearly profits. What are the yearly net profits that a strategy has given? If a strategy has huge fluctuations, like one year it has given 10% and the other year it has given 80%, and then third year again it gave 20%, and fourth year again it has given like 100%, that is not a good strategy. So always pay attention to the net profits that a particular strategy has given at the end of the year, right? 4 years or 5 years, whatever it is, make sure that all these yearly profits are within a narrow range, which means if you have got 40% in one year, 50% in the other year, and 30% in the third year, it is still fine, right? But as I said, if one year it has like 10-20% and the other year it has given 80-90%, it's better to avoid strategies like that, because consistency is very very important for any trading strategy, and your strategy should perform in all market cycles. So if it has performed in all these years, like in the last 4 years or 5 years, it means that it's a good strategy. Even though the returns are a little lesser, it is still a good strategy compared with another strategy which gives a lot of returns but has a lot of fluctuation. So always prefer a strategy that has less variance. And then the fourth and the most important factor that one has to pay attention to is curve fitting and drawdown. Explaining curve fitting is a little difficult, but I will try to explain it in a simple way. Let us say you are performing backtesting on this stock mock tool. Let us say you have performed backtest on four strategies. First strategy has given you around 40% return, and second strategy has given you around 50%. Third strategy has given you 45%, and then the last strategy has given you 52%, right? Now it's obvious that most of us or all of us will pick fourth strategy because it has given more returns, right? Now let me give you an analogy. Let us say there are 100 stocks trading in NSE, and what you thought was, um, let me wait for 1 year, see which stock achieves highest profit percentage, and based on that, I will invest all my capital from next year in that particular stock, right? And after 1 year, let us say there is some stock like Infosys, which has outperformed all other 99 stocks. Now, is there a guarantee that this Infosys will outperform all other stocks continuously for the next 1 year, 2 years, 5 years, 10 years, or 100 years? It is not possible, right? We cannot say that a stock that has outperformed this year will continue to outperform every single year in future. Likewise, if you take these strategies also, if you pick up a strategy which has given highest percentage, there is no guarantee that this particular strategy will give you similar returns or will outperform all other strategies, right? That's called curve fitting in simple. You are already picking up the best strategy, but there is no guarantee that it will outperform every single year in future. If that is the case, you don't need a subject called probability in your academics, right? Probability is all about predicting. If you already know the outcome, then you don't need probability, right? It's just like what a term friction is to mechanical engineers. If the concept or phenomenon called friction is not there, then you can remove half of your subject from mechanical engineering. At the same time, if there is no concept called resistance, then half of the electrical engineering can be removed. Likewise, since we cannot predict the future events, what we have to do is we need to take a few steps to ensure that whatever strategy that we pick, it works in all market cycles. So let's see how we can do that. It can be done in two ways. The first thing that you have to do is whatever strategy that you think is the best, test that strategy on different time periods or timelines. If you go to the stock market, you have an option to group the results by date, right? So change this date from 4 years to maybe 2 years, 2.5 years, 3 years. And even if you want to have different combinations of 2 years, then you can try from 2017 to 19, 18 to 20, or 19 to 21. So try various time periods to ensure that you are getting a good set of results. I know it's a little difficult thing to do this manually for all your strategies, but this is the only way that you can find a strategy that performs well in all market cycles. So I suggest you to spend some more time, and when you are doing the back test, once you're comfortable with a strategy that gives you a decent results, then try with changing all these time frames, and then even after that, if it's giving good results, then you are good to go. All right, this is the first thing that you have to check when you are dealing with a strategy. And then the second thing is, I often see traders do cherry picking. When I say cherry picking, what they do is they think that a particular strategy which has an entry time of, let's say, 10/7 with 32% stop loss performs well on Tuesday. This is the kind of mindset a few traders have. But my suggestion is, do not do too much of optimization or backtesting and cherry pick these numbers like 32% or 10/7 as the entry time. There is a concept called normalization. In fact, entire universe follows normalization if I had to talk philosophically. What this normalization says is parameters or the events that are closer generate similar results, which means when you are testing a strategy and you think that this 32% is giving good profit, try with 30%, 31, 32, 33, 34, 35 as well. At the same time, here also try with different entry times like 10/5, 10/6, 10/8, 10/10, or even 10/15. All right. If the strategy is performing similarly in all these parameters before and after your required parameter, then it's a good strategy. But if it is only performing well with 32% stop loss and only with 10/7 as the entry time, and if it is giving losses with all other stop losses before and after, or with all entry times before and after, I suggest you not to consider these parameters, right? Because before and after it is giving losses, only at that exact time it is giving the profits. That might not be really a good way to pick the parameters, right? There is a concept called law of large numbers in mathematics. Simply put, what this says is, if you flip a coin 10,000 times, the probability of heads would be around 50%, and then the probability of tails would also be closer to 50%. Or if 10 people are playing a game, it can be any game, and they played the game for 10,000 times, there is a very high probability that every person wins 1,000 times at the end of 10,000 games. Similarly, while we are doing the backtesting also, if we backtest the results with parameters before and after parameters whatever are of interest to us, similar kind of normalization should happen here as well, and all these nearby parameters should produce close results. If that's not happening, then your strategy might be an outlier because of some black swan event or something else. And it's always better to ignore such strategies or parameters. So whenever you are picking a strategy, make sure that you are testing with parameters that are closer to the parameters that you picked. So that's the fourth factor. Of course, drawdown. one other point that I would like to add is when you are backtesting a strategy and you see a drawdown, it is always suggested to add 3 to 5% extra drawdown, right? And remember, this is just a test strategy. There are beautiful strategies that you can get on stockmark which has expectancy of zero point 0.7, zero point 0.8 even after brokerages and slippages, right? And the drawdowns also can come down to 5% or 7% in case if you have more capital, and if you are combining the strategies, then you can further get down the drawdowns, right? So let's say your drawdown is around 7%, add 3 more percent and consider that your drawdown will be 10%, so that you won't be disappointed during the real time trading, right? So whenever I'm considering the drawdowns, first of all, I put 1% here as the slippage, and on top of it I remove the results that I get from March and April, and then on top of it I also add 3 to 5% extra drawdown. So that gives me the realistic loss that I might have in my trading account. And then the fifth is correlation matrix. Until now, we have discussed about these factors which you can apply for even a single strategy. But what I'm going to tell you now is for those who are backtesting on multiple strategies, right? At least two strategies. Now, I have two strategies. I'm in this basket feature where you can test multiple strategies at once. It's a very simple strategy. Again, Bank Nifty 30%, 30%, and 11 o'clock is the entry. 15 or 3 p.m. is the exit. Likewise, Nifty also 30% is the stop loss, 11 o'clock is the entry, and 3 o'clock is the exit. Now, the main purpose of having multiple strategies is generally to diversify your fund. Instead of putting everything in one strategy, it's better if you put in multiple strategies. All right. Now, let me run this strategy. All right. Now, I have results with me. This generated a massive 7 lakh profit, and the drawdown came down further. Very good. It's only 24,000, right? Return to MDD ratio is 11 and expectancy is 0.4. Now, what I want to tell you is Nitish has given us a very important option here called correlation matrix. All right. It's a wonderful information that most of the people ignore. What is correlation matrix? Again, I don't want to get into the math, but simply put, correlation matrix actually tells us the linearity between two parameters or two strategies, right? If I had to put it in a more intuitive way, out of 100 times, how many times both these two strategies traveled linearly, or both these two strategies performed in the same way, which means if they give profit, both strategies will give profit. If they give loss, both the strategies will give loss. How many such scenarios happened out of 100 times? If you look at this correlation matrix, it says that S1 versus S2 value is 0.58, which tells us that out of 100 times, 58 times these two strategies performed similarly, which is very, very bad if you think from diversification perspective. First reason why we are investing in multiple strategies is to have diversification. And if your correlation matrix says that, most of the times they are traveling in the same direction, it can be profit or loss, but they are traveling in the same direction, it beats the purpose of diversification, right? There is no point in putting in two different strategies. So when you are backtesting your strategies, always ensure that you make use of this correlation matrix. The general recommended value of correlation matrix is zero point 0.2 or less. It can also be zero point 0.3 or less, but lower the value, better the strategy diversification. So I always prefer to have strategies which are less than zero point 0.2 or zero point 0.3. And what that means is if one strategy is giving losses, other strategy would be in profit. Okay, it's like one strategy complements the other, and so these strategies are healthy and good for your portfolio, whatever be the market cycles, right? So make sure that you pay attention to this correlation matrix when you are backtesting multiple strategies. And then the last but not the least, optimizer. Another excellent feature that we have on StockMark is optimizer, run optimizer. What this optimizer does is It runs millions of combinations and then tells us what is the best combination with respect to either expectancy or return to MDD ratio or various other things. Let me show you one example. So here we have six strategies. One is Bank Nifty with 30% stop loss. Entry is 10 o'clock, and Nifty again entry 10 o'clock. Bank Nifty 11 o'clock, Nifty 11 o'clock, uh, Bank Nifty 12 o'clock, and Nifty 12 o'clock. Basically, it's the same strategy with 30% stop loss, but we have different strategies in the time interval of 1 hour, right? At 10 o'clock Nifty Bank Nifty, 11 o'clock Nifty Bank Nifty, and 12 o'clock Nifty Bank Nifty. So I have run all these strategies just to save some time. You can see that 19 lakh 7,000 is the profit, but obviously we do not get all this profit. The goal here is to find two strategies, one from Bank Nifty and one from Nifty, right? We don't enter into all six strategies. The goal is only to enter one Nifty and one Bank Nifty, but we don't know what is the best combination. We use optimizer for situations like that. So let me hit on run optimizer. I picked three Nifty and three Bank Nifty, and I'm asking give me only one Nifty and one Bank Nifty. Now let me hit on run optimizer. Remember here the sort by option is selected as expectancy, right? Which means uh, expectancy wise, what is the best combination? Okay, and I have hit on run optimizer. If you want to know more about optimizer, you can watch Nitish videos under this education section. You have them. But my point here is not to explain what is optimizer. My point here is only to tell you some of the mistakes that we do while picking the combinations. All right. Now you can see that there are a few results, maybe top 9 results. This tool is showing us. I see most of the times users simply go and pick this top strategy, right? It has the highest expectancy of 0.52. But my point here is it is not a bad idea to sacrifice a little bit of expectancy if you see advantage with other metrics. So, for example, you can see that the maximum drawdown for the first strategy is 22,500 and the days it took to recover is 23 days. However, if you look at the second row, it has a little lesser expectancy, but the drawdown is way below what we have seen earlier. 18,000 drawdown and only 20 days it took to recover, and even the win percentage is 70 versus 68 that we have seen earlier, right? In this case, it's not a bad idea to sacrifice point not to expectancy and pick up this strategy. In many cases when you are running the optimizer, you see that this average day profit goes a lot higher if you can sacrifice a little bit of expectancy, right? So don't simply go and pick the top row. Look at various things like if the average day profit is increasing like 10% or 20% with sacrificing just a little bit of expectancy or whatever is the metric of your interest, then try to pick that. Okay, or if the win percentage is so much, or this max drawdown is way lesser than the first row, okay, try to pick those. You have to look at the right combination. Don't look at a single metric. Look at the combination and then see what suits your trading style. So this is the last thing that I want to explain you. I hope all these six factors make some sense. When we have looked at this first factor slippage, we saw that almost profits came down 40% or 50%, right? From 6,50,000, it came down to 3,80,000. And if you remove COVID time results, then it further came down. So almost 50% of the results that you see on these tools cannot be achieved in real time. I hope you have learned at least a few things through this video. But as I promised, I will tell you the realistic expectation that we can have from strategies like this. What I have observed as per my backtesting and research, the general expectation that we can have through strategies like this is around 40%. All right, if you are a super genius and you can figure out a few more combinations, then maybe you can increase it to 50, 55, or maximum 60%. But it might not be possible to earn profits like 100%, 200%, or 300%, right? So keep it in mind so that you won't be disappointed. And then the next thing I promise that I reveal is two factors that you need to pay attention to in order to achieve these decent returns of 40, 50%. First is execution. Execution actually makes or breaks these kinds of strategies. Let me put it very straight. A normal trading strategy with an automated trading system can outperform an extraordinary trading strategy with manual trading. So it doesn't matter how good your strategy is, if your execution is not laser fast, if it is not emotion free, then you are not going to make profit whatever you do. So the key thing or the make or break deal here is the execution system. You need to make sure that you have some kind of automated trading method so that your emotions will not come into play and it becomes a true mechanical trading system. And then the second point that you have to keep in mind in order to achieve success in strategies like this is discipline. You need to have discipline, patience, and consistency. All these three are very important, right? You cannot keep changing the parameters very frequently even though you have an automated trading system. I see many people, they keep changing the parameters when they get lost for a week or two. Don't do that. Drawdowns or losses are very common in any strategy. You have to maintain the consistency, you need to have discipline, and you need to have patience as well. At times, even after trading for 1 month or 2 months, you might not see much profit. You only see 1 to 2% profits in your account. But that's fine. That's where you need to have patience and you have to continue trading in these trading systems. So, patience, discipline, and consistency are the most important things that you need to have. And above that, you need to have a good automated trading mechanism. And if you have these two things, most likely you are going to see your portfolio growing steadily in long run. Okay, with that, we have reached to the end of this video. But before I close out, let me ask you a favor. Since many option traders are using these backtesting tools, but they are not able to reproduce similar kind of results, I request you to share this video to as many people as possible, especially if you are part of any Telegram groups or any other social forums. I sincerely request you to share this with as many people as possible so that they understand where they are going wrong and it helps them to have a robust trading strategy. And last but not the least, if you want to get in touch with me, you can join this Telegram channel or you can also join me on Twitter. I'm active on Twitter as well. And in case if you wish to avail trading bot, this trading bot is for intraday short straddles and strangles. In case if you wish to avail this trading bot, you can WhatsApp me on this number. Also, please note, you can also avail this trading bot for free of cost for lifetime. Without paying anything, you can avail this trading bot. So in case if you wish to have it, please WhatsApp me and I will let you know the details. I hope you enjoyed the video. Thanks again for watching. Have a good day.